Hello, business finance students. I want to, give you a short lecture about what is the difference by, when we say NPV, IRR. We already talked about it. It's somehow a conclusion of what we said. Let's think about again, excuse me, about NPV, net present value. What is the value of your project that you are going to think about? Think about this as an example that you are buying an equipment for your farm. This equipment, if you buy it, it's going to bring you $2,000 for 3 years in a row. Do you see that? This $2,000 and 3 years in a row. The first year it gives you 2,000, second year 2,000, and third year 2,000. Think about this as revenues it is giving you. It's revenues that are bringing to your company. And then how much should you put to buy this equipment? This is $5,000. You buy $5,000, and because of that investment, you are going to get $2,000, which is $6,000. Should you go and buy that equipment or you shouldn't? It all goes back to, for this $5,000 that you are borrowing from the bank is charging you 10%. Do you see here it says 1.10? 1.10, that is 0.10 is 10%. Therefore, 10% comes from this 1.10. Therefore, you are paying the bank 10% money. You are borrowing 5,000, that's the cost. And then you are getting $6,000, but you have to pay out of that $6,000 10% interest to the bank. Would it be a good deal or not? What you do is, these are the actual revenues that you get. This is the actual cost. You subtract your revenues that you get from the cost. The first year, your revenue is not necessarily $2,000. In reality, it is $1,818 because of that interest concept. And the second year, this is the money that the equipment is bringing you. And this is the third year. Therefore, you add them all together, it comes to around $4,700. You subtract your cost from this, and you end up to negative $26.30. Therefore, your argument is that it's not a good investment. Why should you buy? Why should you borrow $5,000 from the bank and pay 10% interest, and then at the end, you end up losing $26? Therefore, your argument would be that you are not going to go after this investment and buy this extra equipment that is causing you to lose $26.30. Therefore, when you accept a project that the money, when you subtract your expenses for your revenues, it has to be the revenues after the interest rates are calculated. These revenues are supposed to be at least a little greater than 5. The more it is greater, larger the number, the better it is. But it has to cover your cost. In this particular case, it did not cover your cost. Therefore, to calculate your net present value, think about this way. Get your revenues, the benefits to your company, and subtract the expenses from that. And then if that number is a positive number, you go and accept that project. If it is a negative number, then you don't accept it. Therefore, I want you to understand that to calculate net present value, think about this as this way. Get your revenues and then say minus your expenses. This is the way just to remember. And what are the costs of this? This is the cost of borrowing. You are borrowing 5,000. Also, you are paying 10% interest. Therefore, now the question would be, at what point you break even. In order to break even, the cost of borrowing, which was 10%, has to be a little lower. How much lower would it be? It is, we call it $2,000. That's what you are going to get. 1 plus IRR, internal rate of return. That IRR is supposed to be less than 10% interest that you are paying. That way, when you subtract this number, your revenues, from your expenses, that becomes to zero net present value. That means at that time you break even, you cover all the costs. Then when you do the calculation, your IRR should be 9.94, which means if the cost of capital, if the bank tells you that they are going to give you $5,000 and they are charging you 9.94% interest, in that case, it is you just break even. To make more money, therefore, what happens is that we will talk about that. For now, I want you to understand that, your IRR, if your internal rate of return is less than 10%, you do not accept the project. And that means that, in the case, this is, as you see, this IR, internal rate of return, has to be at least 9% for you to to break even, because this 10% that you saw in here is going to cause problem. You do not accept the project. One question you might have is, how are you going to calculate this 9.9% to calculate your internal rate of return? One thing you will do is you come here and say that you click here. What you are going to do, it is 10 years, and it is, your interest rate that you do not know. Therefore, you want the present value. How much your present value is going to be? It has to come to 5,000. When you it brings you $2,000. You put your 2,000 here. And then if the interest rate, the bank is charging you to, $10. When you do the calculation, you will see it comes to 4,900. Your wish was this to come to at least 5,000. Therefore, you will go and say that, therefore, your you put 9.97 here. I think it was 9.7. I put 7.9. Let's see what happens. When I put 9. Do you see it came closer to, therefore, I go and drop this one to 69.69 and calculate. Do you see it came close to it? Therefore, your argument is that the internal rate of return for this investment is supposed to be at 9.69. At that rate, you recover, the cost for you. At that time, you are not, even still, if I were you, I wouldn't accept the project, because why should you go borrow 5,000 and just make $5,000 on it? If your expenses total, present value is 5,000. Therefore, I want you to understand the relationship between net present value and IRR. You want your net present value, which is right in here, to be a positive number here. That means if this calculation had come to a number, greater than 5,000, then when you subtract a number greater than 5, let's say 6,000 minus 5,000, if it comes to 1,000, then you say, oh, I have a net present value of $1,000. Therefore, to calculate IRR is that when you say your revenues minus your expenses should be zero. IRR is the number that makes your net present value to be zero. When it becomes the zero, you calculate that rate that is going to give you a break-even point to make your revenues equal to be equal to your expenses. Then in that case, you will come, here is another example. When you buy an equipment, the equipment is costing you 4,000. It is going to give you a $1,600 every year. When you subtract, your net present value is, negative 21. You say you don't accept the project. Then the question would be, what would be the IRR? That means that what should be the rate that brings these revenues to be equal to your expenses. Therefore, you use the same example and you do the calculation and you come with a number. Now, in one particular case, this particular case, it is when a net present value is a positive. Do you see here is $476. In this case, you accept the project. And here, in order to calculate your IRR, you put 1,800, you can go to the same calculator and put the numbers in there to calculate your IRR. Let me do it since we are already here. I click here and it is 3%. And then I come here and I would say that I want to, to see what number when it is giving me $1,600. This is $1,600. Let's say, and I am hoping to bring this to 4,000 because in this case we are borrowing 4,000. Oh, it is 6.9%. If it did calculate, correctly, it came to 6.9%. Then I go back to my example, and therefore, let's see what it is. I'm sorry, it was 1,800. I go in here and I go to 1,800. And I say calculate. This is, do you see this is 4,000? The investment was supposed to be 4,000. Therefore, in order to drop this one, to bring it closer to 4,000, I have to change my IRR. Let me see it 10%. Okay, let me go to 14%. Do you see when I am getting closer to, to here, I go to 13.5. And I go to 13. I don't know, for some reasons, it doesn't calculate properly. And let me, let me go to 12%. It's some reason the calculator is, messed up. Okay, I go to 14. Okay, and I go to 14.14, for example. I'm just getting different. 14.45, 14.75. Okay, but just I want you to see how closer I am getting. Let me go back again to the example here, and it says that IRR is supposed to be 14.48. Let me put 14.48. Okay, it doesn't calculate at the properly. I should clear the screen because it's supposed to come to, $4,000. But just I want you to understand the concept in here, what we are trying to achieve, and we are trying to see for us to break even in this investment, we have to have our internal rate of return is supposed to be 14.40%. Therefore, if the cost of capital is 10% in here, which is right here in this case in here, then we accept the project. We say, okay, bank, the 10% interest that you are giving us, that's a good rate, because if you gave us 10%, our net present value is a positive present value, and we calculate, we accept the project, and we go and buy the equipment. Therefore, for you to accept the project, your IRR, internal rate of return, is supposed to be greater than cost of the capital. In this case, we used a simple example of the bank. But let's not forget, in businesses, cost of capital is not just the bank. It might be the cost of issuing new shares for the new shareholders. Do you see? We have already done that with the weighted average cost of capital. It's something that, I want you to think to get some sense of what we mean by IRR. IRR, internal rate of revenues, brings your revenues and make them equal to your expenses. That means that if it makes it, you want to, that's a very magic number, which means at that number, you break even. If your internal revenues is greater than what is the cost of capital, which what the bank is charging you, then that means you are having a better return. When you have a better return, that means your NPV is greater than zero, net present value. And in that case, you accept the project. And I saw an interesting case because one time the calculator miscalculated. I did the calculation and it gave me something. And it was in the case of that you can use, Excel. Do you see? If some of you might say, oh, you don't want to use this financial calculator, which is on the internet. Can you use Excel? The answer is yes. I don't want to go to it. You go to Excel, and then in Excel, I haven't tried it, but it should be very simple. You go in there and you click on finance for those of you who are interested. And then you put, if then in finance, it says, what do you want to calculate? You click on IRR. Then you have to give numbers. The numbers that you give is that it asks you how much your initial investment is. You put, negative 4,000. That means that's the money you are borrowing. Then it asks you, when you put that, how much are you going to get your first year and second year and third year? When you put that and you say calculate, then it will calculate what rate is supposed to be. This is for another example. It's Excel. The example is about this one, 1800, and what is do you see that at the IRR you break even. Your revenues in this case, which are $1,800 a year, are supposed to be equal to $4,000 that you are paying. And in that case, it is calculating, and Excel is giving you internal rate return of 16.67%. And of course you could use the same calculator and put these $1,800 as periodic payment. And one last thing I want you to tell you, there are three ways to use. One, you use Excel. One, you use financial calculator, or you can use those tables at the end of the book. The end of the book, in order to do that, if you remember, it asks you how much, we call it annuity. Why it is annuity? Because it is giving you $1,800 for 3 years. And then, the initial money you are giving $4,000, imagine, to a bank. The bank is giving you $1,800 for 3 years. And you are asking the bank, the table at the end of the book, that what rate of return is the bank, what interest the bank is giving you, that makes your, $4,000 to be equal to, what they are giving you. Therefore, these are the same concepts, little variation.